Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me at the market site in Times Square, we have Chris Dearborn. He is NASDAQ's Managing Director on the Market Intelligence Desk, and we're here for your midday update. Looks like the major averages are down about 0.5%. The Dow and S&P ticked in the green for about maybe 15, 20 minutes at the noon hour, but it's been a pretty muted market.
It's been a flat day for the most part. You waffle back and forth for the major indexes, a little bit more skewed to the downside than the upside. The Russell 2000 is a little bit positively skewed this morning. What really happening here is you're not giving back yesterday's gain. You had a broad-based rally yesterday. Markets are up significantly in the back of earnings, though volumes on the trading scale of things were kind of light. Would love to have seen north of 7.2 or 3 billion shares trade yesterday. We didn't even get to 7. Earnings season's kicked off with a bang, but the volumes are whimper.
Well, it's really interesting that you're talking about volumes. One of our analysts in their morning note had noted that the volume days are significantly heavier on days that were down, and the days that were trickling higher, the volumes are much lower. And I know when you hear stats like that, conviction is the issue.
Absolutely. So it's really conviction, and that's the key there. Where are the investors putting their money to? People have their finger on the trigger. They are panicky. Whenever there's a headline that is negatively skewed, whenever there is some type of broader macro theme that could put impact to the market on the downside, people are pulling that trigger and getting out. What you're looking for on the upside is slow conviction, that Goldilocks mentality, where people start to slowly build up on the things, which kind of bodes into what will happen today, right? So you had some decent economic news out today. The retail sales were weak on the print, and September numbers were light, but August was comped up significantly across the board. So it really wasn't as bad as the headline number read. So what you're looking at there is concern of a slowing consumer here in the U.S., and that is troubling, right? U.S. economic spend, U.S. Consumer spend is 100% important to this economy. It's 2/3 GDP, and it's what's really been holding up this market for such a very long time. If there's any cracks in the armor there, there's going to be fear coming into Q4. Remember, Q4 is the all-important selling season for most of the retailers here, and if the consumer's not out there with their pocketbook using their credit cards, you're going to have some issues there. And on top of that, that showed up in today's Fed fund future rate, which ticked up to an 85% chance of a rate cut at this month's meeting on the 30th. So that was only 70% last week at the end of the week, and a little bit lower than that beforehand. So there are concerns, and we have to see how that plays out.
Well, if we keep getting weak consumer data like that, they're going to have to use some of that ammunition. And a couple of reports I read going to the holiday season, while estimates are down, not necessarily negative, but they are certainly down from last year. Let's take a look longer term, though. Let's pull up our first chart, the S&P 500.
So this is the best chart to look at. It's, again, what you're looking at here is how well the large cap names here in the U.S. are holding up, and they are. You're still only a stone throw away from the all-time highs made over the summer. The S&P 500 ticked over 3,000 again yesterday. Right, you haven't had that in over a month. We haven't fallen below the major moving averages, which you see on the yellow, the purple, and the green line here. And the volumes are okay. They're not great, but they're not terrible. Last week was kind of slow. Last week was the slowest month, the slowest week since back to August, right beforehand. If you can see the volumes start to tick up here, 7.1 billion. That's a good thing here. The S&P needs to rally on some strength here. We have earnings coming up. We'll see what happens. But again, it's still a macro environment. You have Brexit. You have political tensions, you have impeachment items coming up. All these macro concerns could move this one way or another. Right now, it's still positively skewed.
Right. Well, it's really interesting because we literally are exactly where we were about a year ago, even 18 months ago. But what's good about this market is if you're picking, it's a stock picking market. It's definitely a sector picking market. So people are still making money. It just depends where you are. Now, let's take a look at the pound because in addition to all of the U.S. macro headlines, we have to contend with Brexit.
My colleague Brian did a great job pulling this out today. We put it into the note. And what you're looking with Brexit on imminent, right? The October 31st deadline, they have some significant talks going on here. Hopefully we'll get some news one way or another. Hopefully it'll be something positive here. The British pound is going to be a key factor into that and spill over to other markets like the euro, the US, and some of the manufacturing items that rely on this. What you're looking at is a breakout situation after a double bottom that he pulled back in 16, which was originally announced when they announced Brexit out of the gate. It rallied into the talks, hit a double top, and then failed. And you're hitting support here recently on the positive talks, saying that you're going to have some type of good Brexit that's going on here. If you have a bad Brexit, the pound will suffer, the euro will suffer, the dollar will rally.
Right.
That is a bad negative impact for the market. However, if this works out smoothly as people are hoping for, and it seems like they're trying to make that happen right now, you could have significant legs to this rally and the pound, which would mean a lower US dollar, which is good for us too.
All right. Well, the next 2 weeks should certainly be interesting between Brexit, the Fed, earnings, all that good stuff. We'll catch up on Friday. Thanks so much,
Absolutely.
Chris. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.